Let us today discuss about the stock market, where is it now in India, and how we can see it, where it is going, and what are the implications for common people, learners, educators, as well as investors who depend on the market and its health. Currently, we can see there are two kinds of people. Few are saying that they are not investing in the market, saying that it is too much overvalued. Whereas there are few who have invested when the market has risen, maybe from March 2020 onward, and they have invested at a higher level and their portfolio is in red now. That is, they are losing money. So why is it? To discuss it first, let us think about valuation. What are the basic principles of it? Basic principle is about present value of future earnings. So what has happened in past doesn't have any implication on the valuation of a market that is at present. So what we will earn later in future, that is having strong implication. As you can see, the market, look at the blue line. We're talking about Nifty 500. It has gone down from a 12,500 levels to 7,000 levels and again gone up to 18,000. And the recovery happened with an overreaction. But what happened to the earnings? Future earnings are drivers of present valuation. We have discussed already. So what happens to the future earnings? So future earnings have not caught up during the period, but later on, starting from March 2021, when we started recovering from COVID and businesses came to normalcy, it has also increased. Today the market has recovered a bit after the Ukraine fiasco. The market has dropped to 15,800 levels. It has gone up a little, but still, is the valuation lucrative? Should people start buying? So if II investors or foreign portfolio investors, they are taking out money from Indian market every day. Since they are taking out the money from Indian market, the Indian market is falling. So who are buying? We, the domestic investors, are buying. In the light of the current PE ratio valuation, in a PE ratio valuation, the market seems well poised for the next period of growth. So if anyone who is targeting a long-term growth in portfolio, in the wealth, then they should buy at this point, and in that case the buy should be in a staggered manner. So SIP at this moment is a safer bet. If the companies can elevate their expenditure into capital expenditure into higher levels, create more usable fixed asset and utilize them by incorporating higher technologies and more productivity, then only we can see what people are touting, that Nifty will go to a 50,000 levels. How much yield or future return do we expect? Not more than 12 to 13%, because we are now already in a lower interest rate, lower inflation regime. Although it is being fed currently by the higher oil prices, but still government's goals are to keep the inflation low at 5 to 6%. Now top of it, add something like 6 to 7% real GDP growth rate. So India as an economy will grow at a nominal rate of 13% at the most. So you should not expect the market as a whole to give something more than that. So days of 15% to 20% returns are gone. By choosing a few stocks in upcoming value stocks in mid-cap, small-cap space, some people might take more risks to gain that more return. But more or less the market will give us 12 to 13% and not 15%.